travel, and they're saying, no, I can't accept that. And you're saying, but I had a business conference, huh? You were there for 3 weeks, you only spoke for 1 day to receive your award, and you want it to be a business expense. This is the stuff that people are going to be able to see from the 1st of April 2027, overheads. So effectively, everything comes up in overheads. When you're saying my tax is too high and you're not keeping your receipts well, your overheads are understated, again, it affects, again, the tax that you pay. So hopefully we get a good understanding of what overheads are. Last but not least, you then come to your net profit or loss. Effectively, when we look at your revenue, COGS, gross profit, overheads, are you in a profit or are you in a loss? If you're in a profit, we then have to pay tax to the taxman at 19% up to 25% sliding scale to HMRC, which is paid 9 months and 1 day after your company year end. Again, really, really good to make sure that your accounts are done on time, nice and early. And also, you don't need to wait until 9 months to know how much, until the year is over, to know roughly how much tax you're going to be paying. You need to be having these regular conversations with your accountant so that the tax bill is not a surprise. You're not caught unaware and you're thinking, but where's the money? Something we hear a lot, huh? I didn't even get this money. Are you sure this is the tax that I have to pay? Again, plan nicely. Understand this so that you see this. Now, the good thing about the P&L is it resets every year. So as soon as your financial year starts again, everything is wiped to zero. Then you start again. I am saying this so that at the back of our heads, we can keep this in mind. There are consequences to everything that we do. And I will show you some of them as we go on. Now, moving across to the balance sheet or statement of financial position. This is essentially a snapshot of your business financial position at a specific date. It's at a point in time. So you see this will be as at, it has to be at a point in time. And the reason why that is so that we can, one, verify most of the numbers that are in there at that particular time. Now, with our balance sheet, what do you need to understand when it comes to your balance sheet? Again, it's your legal responsibility to make sure that you understand this and that your company can pay off its debts. The balance sheet helps you spot problems early. It essentially gives you a better picture than the P&L. It also shows whether you're too dependent on debt or you're building value for your business. What can this tell you? It can tell you whether you have enough cash to cover your to cover your bills, your short-term current liabilities, at risk of insolvency, and effectively, can you invest or are you able to expand, i.e. make those strategic businesses or decisions that you want to make. Unlike the P&L, we're only going to focus on 4 key items here, hopefully, as I get ready to conclude. So essentially, we're going to look at your fixed assets, current liabilities, shareholders' equity. If you buy a property in your name, it's not a business asset. Yeah? If you buy a car in your name, it's not a company car. Yes? I'll repeat that. If you buy a car in your name to reduce the tax that you're paying to HMRC, but you then register the car in your name and the contracts are in your name, that is not a business car. That is a personal car. Okay? So for an asset to belong to the business, it needs to be registered to the business. I'm sure you understand you and the business are 2 separate legal entities, right? Yes. Yeah. So again, one mistake we see quite a number of times when someone says, oh, we have these assets on our books, show us the paperwork. Nothing is registered in the business name. The business can't pay for that. It's not a business cost or a business expense. And most assets are not expenses, so be careful. When you're buying assets and you're thinking you're increasing your expenses, as most fixed assets are not expenses. Current assets. This one for me is a bit of a painful one because effectively when we speak of current assets, we're talking about what things do you have that can easily be turned into cash so that you can pay your debts. Number one, the cash that you have in the bank, the money that you have in the bank. It's already cash, so that's a current asset. Hopefully that makes sense. The second one is what we call trade debtors or trade receivables. These are effectively invoices that you have issued, but they have not yet been paid. So remember those invoices we spoke about when we were talking about revenue? Trade receivables. This is why it's really important to make sure that when you raise an invoice and it's sent out, it's recorded in your accounting system. It comes and it sits here. It shows, again, the invoices that you can quickly turn into cash. Essentially, because we know they're going to get paid before they become a bad debt. If they're bad debt, you need to have a policy within your organization, i.e., do you write off bad debts after 6 months, 1 year, or 2 years, so that we remove it from there. Because we can't overstate our trade receivables to say we're expecting to receive 200,000, but that money is not coming from anywhere, or we have never raised invoices for that sort. Hopefully that makes sense. Good. Now, when it comes to you guys, when you sign your accounts, this is one of the documents that hopefully your accountant gives in front of you. One of the things that you see there is your company bank account or company bank accounts, right? Yeah? Remember, balance sheet is at a point in time. It shows you what your bank balance is at your year-end date. If your year-end date is 31st of December, it will tell you your bank balance in your NatWest account was X. It's amazing how many accounts get submitted with an incorrect bank balance. I know it's painful because I'm almost asking you to redo your accountant's job here, but I'm asking you just to be diligent, to be vigilant, and to see whether they've just done the basics that they should do. Imagine your accountant files your accounts saying that you had 50,000 in your bank when you had £5. Yeah? Where did the £49,995 go? Where did you spend that money on? When I see that bank moving from 50,000 to £5 next month, I'm going to expect to see you buying something or transferring money somewhere, that money coming out of your bank, but you never had it. Now, we can't just erase that and say, oh, last year they made a mistake, this was supposed to be 5. No, it will come with an impact to your P&L, to the amount of tax you're going to pay. I'll repeat that. Anything that is incorrect here on your balance sheet will come back to your profit and loss account to correct your accounts. Unlike the P&L, the balance sheet does not reset every 12 months. It continues for the duration or the lifespan of your business. You build onto this year on year on year on year on year on year. Hopefully that makes sense. This is really, really important. Let's understand what we are signing. Let's ask those questions. It's painful to hear that some accountants don't even have meetings with their clients to sign off accounts. They just give you to sign, then they submit without explaining anything. Please stop doing that if you're doing that. Request a meeting with your accountant. Have them explain what they have done. Make sure you verify that which you can verify without redoing their job. Because like I said, when you investigated and they'd resigned, that falls back on you. Current liabilities. This is essentially, who do you owe money? So for those of you who are notorious about not paying HMRC for your PAYE, that balance should be sitting here. I'll repeat. You're thinking you made a profit last year, when in actual fact you made a loss. So this accountant made you pay tax to HMRC when you should not have paid tax. Yeah, you're making business decisions on a profit that was never there. Do you know how dangerous that is for your organization? It's expensive, someone said. If you miss early warning signs, again, have regular review meetings with your accountant, quarterly management accounts, half-year management accounts. Don't just speak to your accountant when accounts are going to be submitted. Now, you can't just turn up now after this, call your accountant and say, well, how come we're not having management accounts? Because I'm sure it's a service they charge for. And to you directors, I'm challenging you, invest in that service. It's a service worthwhile. It's a service worth investing in. Reputation and operational risk. If you are not looking after your business well, you sign things that you do not understand, it can even affect some of the councils and the contracts that you're working on. And I'm sure we understand this, right? Silence, I will take it this time because I too am tired. Financial instability. This is another danger of not understanding what you're signing off. Now, how can we help you? And as mentioned, we can help you make sense of your numbers. Put simply, accounting doesn't have to be jargony. It needs to come down to the level where you understand what you're doing and how your business is performing and effectively what you're signing off. We can make sure that you're compliant and we reduce the risk of your business. Now, I can't pay tax on your behalf, but I can tell you the dangers of not paying tax, and I'll warn you where you're heading with your business. That decision still lies with you. but at least I have made it known to you. We can also help improve profitability. It's amazing how many businesses have different offices in different locations when sometimes you don't even need them. You have just increased your expenses for the sake of expenses, and yet you're running a loss on something that could be profitable. Again, we can help you with this. Did you also know you can actually go to the council and say the package that we had is no longer profitable, and you request a percentage increase of your contracts? Did we know? No. Or we just wait for the annual inflation number where they give you 2%, inflation was 5%, and you're thinking, how is this making sense? You can, but you need evidence before you go there. You can't just go and say, I need more money because I'm not profitable, yet you're abusing expenses. You need to make sure your numbers make sense, you have done the work, then you can approach them. And sometimes they do listen. Sometimes they do listen. Again, strategic advice for growth. It's things that we can offer to you. I do apologize for taking a bit more time, but thank you so much, ladies and gentlemen. Please do give us a follow on LinkedIn, Facebook.